My name is Michael Guyette, publisher of the Lead Lag Report. Joining me today is Mr. Gary Shilling. Gary, it's been a while since you and I last chatted, and you may not remember this, but probably a decade or so ago, you and I both were on Bloomberg together. So I know your background pretty well, but there's some people that may not be familiar with your name. So if you wouldn't mind, Gary, just introduce yourself to the audience. Who are you? How'd you get involved, interested in markets? Talk about some of the key highlights of your career, and what are you doing currently?
Okay, well, glad to be with you. We're economic consultants and portfolio managers. We eat our own cooking, manage money on the basis of the themes that we develop from our forecast. And we start with an overview of the financial sphere, the economic sphere, and the markets, and then combine those into a forecast and see what logical investment themes follow. And it can be commodities, it can be stocks, bonds, currencies, can be long or short. I don't believe being short is unpatriotic. And there are times when that's the way to go. And we've had a lot of success at certain times being short. But in any event, I've always been guided by several very fundamental principles. One is that human nature changes very slowly over time, if at all. And that means that people react to similar circumstances in similar ways. In other words, history is relevant. Now, that doesn't make it easy because you got to find the right piece of history that relates to what's going on now. But if you can do that, and then you kind of look at what follows, it gives you a pretty good idea. We've done that. We did that certainly in predicting the submarket mortgage collapse. We started noticing the extremes there in the early 2000s and followed that up to the top, and then they collapsed. But that's certainly important. But where you really make is by seeing what's new, rare, strange, and exotic. What are the features out there that are outside the purview of the consensus? Now, the consensus, and this is really the vast majority of Wall Street analysts, are paid to be bullish. And I know from my own experience that if you're bearish, it can be very, very lethal for job security. That's why I set up my own firm. In 1978, I'd been previously chief economist at Merrill Lynch, first chief economist, and then at White Weld. Merrill Lynch bought White Weld. I was fired twice by Don Regan, who was the head of Merrill Lynch, because he didn't like the idea of anybody being negative. Whether I was right or not had nothing to do with it. But the point is that it means you have to look at the situation and look at what is different. What doesn't the herd see? Where are the opportunities? And that's where you can add value. I mean, rehashing the consensus, which is most forecasters do, to me adds very little value. So those are the two basic principles that we use in evaluating the economy and financial markets.
I think a lot of people know you as, the guy who got the bond bull right in the early 80s. I'm curious just to hear your take on the way rates, long duration treasuries in particular, how they behaved in the last 3 years, especially given what seems like a failure of a flight to safety dynamic in government debt.
Yeah, well, you're right. Actually, in the early 80s, I came out and stated in writing, we're entering the bond rally of a lifetime, because I thought that inflation was unwinding and treasury bonds are very closely linked to inflation long run. As a matter of fact, if you get the inflation forecast right, you got about 90% of the volatility in 30-year treasury bonds. So on that basis, I felt inflation was unwinding. And I said, we're earning the bond rally of a lifetime, and got very, very bullish on bonds. And it's helped our clients, and certainly helped us in our portfolios we manage both individually and for the firm. Now, of course, the question is that bond rally of a lifetime over? And all I can say is repeatedly in the last 30 years, the chorus has said, yes, it's over. Yes, it's over. Rates can't go lower. Rates can't go lower. They can't go lower. And, they're going to stop going down at some point. But I think you've got to see a very big change in the fundamental picture. And I'm talking about the longer term effects, not the day-to-day fluctuations. But one of the key factors here, of course, is inflation. And if you look at what drives inflation in the long run, a very key factor in today's world is globalization. This obviously started in China about 40 years ago. And it simply is a matter of combining Western technology, advanced technology with cheap Asian labor, produces a vast array of products, which a lot of them are exported to North America and Europe. I wish I could show you this face to face, but I've got a watch on. It's a watch, LED watch. I bought this in Costco, $9.95. $9.95 for a watch with an expansion band. Matter of fact, I bought 3 of them because when the battery runs out on the first one, I'm not going to bother trying to get it replaced. I just throw it away and go to the next one. And you say, wow, how can you possibly do that? Well, it's basically cheap labor and Western technology. Now, of course, China is now in a different situation. China's growth is slowing. China has got a major problem with the weak property market. And more important in the longer run, who's basically present for life, does not look at economic growth as the key objective. That was true under his predecessor, Xi Jinping, in the last, starting 30 years ago. But Xi is much more interested in control. And that's really reminiscent. We did a study of Chinese dynasties going back 5,000 years. My wife and I were taking a trip to China, so I got all these CDs, dynasty by dynasty. And what you find is historically that they do very well until they run into problems. Problems usually caused by high unemployment or famine. And of course, that's the key concern of that's the only thing that really keeps the Beijing regime in check and what I call the Mao dynasty that we're now in. But Xi really doesn't look on economic growth in the Western sense as being terribly important. As a matter of fact, he looks on it as giving people more power, consumers more ability to make their own decisions. And that's not the whole objective of the Communist Party. So you have a situation in China where you do have slowing growth right now, but it's not going to collapse. And as a matter of fact, just seen in the last 24 hours, Beijing has eased up on mortgage rates and taken other actions because they simply do not want the economy to collapse again. These guys study their history, and they know that if they don't want another Tiananmen Square kind of situation where rising unemployment breeds social unrest and threatens their power. So China is growing, but much more slowly. Second largest economy in the world. It has surprisingly little impact on the U.S. Imports and exports from the U.S. to China back and forth aren't all that great, but China has a big impact on a lot of other countries, on commodity markets and so on and so forth. And it does make a difference to the world. And if you have slowing growth in China, and I think that's basically what the regime there is very content with, it's another factor in slowing the world's economy. Now, we talked about globalization. Well, globalization, it's moving out of China. With the political problems there, with the militaristic attitude, we obviously are cutting back our involvement in China. But globalization, again, as long as you have cheap labor, and a lot of it is in Asia, but some of it's in Latin America, as long as you have cheap labor and advanced Western technology, without all-out protectionism, it results in globalization, cheap products. Moving out of China, where's it moving? It's moving to Vietnam. Huge expansion in exports there. It's moving to Bangladesh. It's moving to Thailand. India is ultimately the 800-pound gorilla in the room. And I think that India, I'm very bullish on India for number of reasons we can go into. But I think that India is ultimately the biggest winner here and will surpass China in many respects in the next decade or so.
So it doesn't sound to me like you necessarily believe that the deglobalization narrative that's been touted for the last several years is just shifting from China to other low-cost labor areas, and that still is ultimately a longer-term disinflationary.
Yeah, that's right. That's right. I think that globalization deflationary pressure is still very strong. It's shifting, and obviously it takes time for these other countries to build up the infrastructure, the capability, the labor training, and so on that China has done over the last 4 decades. But they're getting there, and they'll continue to get there. And again, the economic opportunities are just too great to be ignored, either by the people producing goods in Asia and elsewhere. And Mexico is also among the winners here. But between them and the Western technology, I think the whole process continues.
I'd be curious how you think about the AI narrative and hype. I've noted many times that there's a disconnect in terms of the idea that artificial intelligence is disinflationary longer term, while 30-year yields have kept on rising. Is there anything to the idea that also is sort of an underappreciated force against inflation?
Well, artificial intelligence, of course, is the latest buzzword, and a lot of discussion now about it throwing people out of work and so on. People who are strong believers in that really haven't studied history. If you go back to the Industrial Revolution, I mean, that was really big time. This is just a minor extension of that. But you go back to the Industrial Revolution, when you went from people producing shoes and clothes and textiles and so on by hand to doing it with machinery and automation. I mean, that's when the whole thing really started. And what's fascinating is that back then, a lot of the workers in those, the hand weavers and so on, they were pretty upset because they saw their jobs disappearing and they became saboteurs. Saboteur really comes from the word sabot, S-A-B-O-T, which are the wooden shoes the workers wore back then, and they would grind them into the machines to break them. So hence they became saboteurs. They were trying to get rid of this challenge to their hand work. Well, of course, what happened was that the Industrial Revolution created more jobs than it destroyed. Now, obviously, it changed. If you've ever read Silas Marner, he comes back to Lantern Yard, and the Industrial Revolution has hit the place. In the meanwhile, in his absence, and it's an entirely different deal. And George Eliot doesn't really discuss in detail whether his hand weaving is going to survive. But the point is that individuals obviously are affected by technological change, and some people get retrained and reoriented, and some people don't. But that's been true for the last 200 years or more. So I don't see anything really all that unusual. And the idea that artificial intelligence is going to eliminate, a quarter, a third, half of all the jobs out there, maybe it changes them. Maybe it changes them in certain ways. But what is this? It's simply advanced manipulation of data. And data has been tabulated for decades, centuries. And it's just a question of how you organize it and what you do with it and the speed with which you can manipulate it. And that's what AI has contributed. I think it's evolutionary. It's not revolutionary.
So let's get into your forecasts around a recession, it not being a soft landing. I saw some of the prior headlines around recent interviews you've done, and that's why I changed the name of the space to a violent stock collapse that ahead. Now, I'll preface this by saying I'm very loud in saying that I think there's a credit event that's out there somewhere, just because, the lagged effects of the fastest rate hike cycle in history, going back to your point about history is relevant, you need the right piece of history. There's no real history around what has happened to rates, especially in the last year and a half. Lay out the argument for why you think we're still headed for a recession. And again, I'll stress that if it's about the yield curve, you and I both know people only care about the yield curve when stocks go down.
Well, it's a yield curve, the leading indicators. Those are the reliable forerunners of recessions, and they're all pointing to business decline. But the real guts of the matter is the Fed is determined to knock inflation down to their 2% target. Now, in our monthly newsletter Insight, I've talked for years about the relevance of 2% and why they picked 2%. And all central banks have 2%, and none of them, to my satisfaction, have ever successfully explained why they have 2%. But forget that, they do. Anyway, the Fed is determined to get back to 2%. And they are absolutely convinced, and I think rightfully so, that if they don't, that their credibility is really shot. The suggestions we've had lately that maybe they ought to raise the target to 3%. Chairman Powell, in his recent speech in Jackson Hole just said, no way. And you can understand that they simply do not want to suggest that they are backtracking on this whole deal. So you have a Fed that is really determined. And you've got a tug of war going on. Matter of fact, I just finished our September newsletter Insight discussing this as a major topic. And you got this tug of war going on between investors and markets, which are looking for a soft landing, and the Fed, which is really saying no. And I'll bet on the Fed. I think they have the determination. They've got the ammunition. And of course, they'll no doubt precipitate a recession. It's probably already in the cards if it hasn't already started. But the point is that it takes time for all these things to work through. And, let's say we've already started a recession. Well, even if the Fed reverse gears tomorrow, it wouldn't have much effect on what happens for the next 6 months or so. So I'm betting on the Fed. And I think that the indicators, like you mentioned, the yield curve inversion, leading indicators declining, things that are very reliable forerunners of recession, they are pointing to business slowdown. And I think they're true. Now, the soft landing camp, obviously they point to things like the continued expansion of jobs. It's weak. It's not nearly as strong as people talk about. They talk about real incomes, real wages are increasing in the last 5 months for the first time in 2 years. Yeah, but nominal wage growth is declining. That's really because inflation is falling. The real pay is increasing. And if you look at consumer spending, retail sales in real inflation adjusted terms are declining. People are very cautious. You look at people, they spent an awful lot of the handout money they got during COVID. And you can see the leap in credit cards, $1 trillion credit card debt out there. And now, of course, as in October, we've got student debt repayments coming on top of that. So, you've really got a consumer that, despite recent optimism, according to surveys, I think is really being stressed.
I would add that's one of the also great disconnects about this new bull market narrative. If you look at retailers outside of Amazon, you just look at an XRT ETF, equal weighted, retailer type of proxy, that's closer to the October lows of last year than the highs. So to your point, the things which are most sensitive to the consumer, the stocks are just not responding, probably because they're seeing that there's some real stress coming down the pipeline.
Yeah, there's a lot of interesting things going on there. I mean, one is that the people are trading down. You're seeing a concept that we developed decades ago called small luxuries. People want the feeling that they're buying something that gives them the satisfaction of a luxury good, but it's got to be cheap. So what it is, it's perfume. It's small items, cheap handbags, maybe things that make people feel good, that they are partaking in luxury, but they don't cost nearly what they did before. And when you see this evidence of people pulling up in their Lexus to shop in dollar stores, it tells you something.
To get back to that longer run 2% inflation rate, it's my sense that you'd need to have some period of outright deflation, right? It's like if you're gonna go back to 2%, you presumably have to go past 2%, right? Mean reversion means you have to go past the mean. And that would be consistent, presumably, with a recession to come. But against that, you have stocks, at least the headline averages, still pretty resilient, right? Despite all the other weakness beneath the surface. How important is the stock market's movement to bringing inflation down? Because let's face it, there's a wealth effect. There's a connection between the S&P and NASDAQ, and I'd argue even, animal spirits when it comes to housing.
Yeah, well, there is a real wealth effect, but it's relatively confined to people at the top of the income and asset spectrum. If you look at the breakdown, and the Federal Reserve has what they call the Survey of Consumer Finance that breaks it down, and stocks, bonds predominantly owned by higher income people. And those people don't tend to be nearly as sensitive to economic conditions as lower income people, as you'd expect. They've got reserves. They're not really hit by weakness. But so there is a real wealth effect, but it's relatively small. I mean, some of the numbers suggest that if you have a 10% decline in stock prices, maybe it knocks consumer spending down by a percentage of a point. I mean, it's really pretty small.
Get to some of the audience up here. The question was the sort of memories of the recession of 74.
Yeah, well, that early 70s was a very interesting situation. And it was a big inventory recession. And we sort of came into it by happenstance. We were doing some work for some clients, steel companies. And we noticed something very interesting is that the steel production looked like it was much greater than would be indicated by steel consumption and putting into machines and autos and so on. And one of the big problems with steel is that they had at that point the middlemen, warehouses they call them, and they basically bought steel from the producers, the U.S. Steels and Bethlehem Steels all the time and so on. and then they would process it and sell it to manufacturers and so on and so forth. But they did not report their inventories. But we said, hey, wait a minute, you got big production here, you got weak consumption of steel. There's got to be big inventories, and we expanded that whole concept. And actually, in 1973, came out with a full-blown report that there was a massive inventory building spree going on, the likes of which we hadn't seen since right after World War I. After World War I, they took off price and wage controls. Prices exploded. Everybody was buying to beat further price increases. It was inflationary expectations. But then all the double and triple ordered goods arrived. And in 1921-22, you had the sharpest recession on record. It was the steepest decline on record. And again, that was a case where we saw that as a model for what we thought was going on in the early 1970s. And it basically proved to be correct.
Go a little bit further in terms of just the recession focus. Yeah, last year, everyone was convinced it would happen this year. This year, everyone's convinced it's not going to happen. If you're going to put a time frame, and I know this is obviously not a science in terms of time frame, but yeah, how do you think about sequence in terms of when a recession could end up playing out?
Well, that's always a tough one because there are differences and the sequence is never completely consistent. But normally what happens, and I don't think this is going to be too far from the norm, the Fed tightens credit. That basically kills the interest rate sensitive areas, housing first and foremost, because it's so dependent on borrowing. You think about it, if somebody puts down 3% for an FHA mortgage and borrows the rest, they have a 33 times leverage. I mean, that's huge leverage. So it doesn't take much in a change in interest rates or prices of the house to cause major difficulties. And that, of course, is what we've seen. And this is very, very typical. The Fed raises rates and it affects residential housing first and foremost. Then you see it spreading as we have to commercial real estate. And that's somewhat a unique situation because what's going on there, of course, is that with COVID and people working from home, they don't want to go back to the office. Only about 50% of people are back at their desks, despite admonishments by employers. And that means you've got huge excess office space, and a lot of it, the leases are coming due. The tenants are walking away. They're, as they say in the trade, they're turning the keys back to the landlord. So you've got that as a added feature, which is greatly magnitude this time because of the effects of COVID. So that's what typically happens initially in a recession. I think you've seen it. Then you start to get to layoffs and weakness in consumer spending as a result. And we have seen layoffs, of course, particularly in the tech area, where a lot of those people were very well paid. Layoffs have been delayed, though. And that's one of the reasons I think this whole recession is going to stretch into next year, because employers spend so much time and energy hiring people that to turn around and fire them, even in the face of declining corporate sales and profits, it takes a complete 180-degree change in mentality. But it's starting, and I think it will pick up. If you look at recent data, for example, this came out on job openings. Job openings were down, I think, over 300,000 in July and just reported. And the gap between the number of jobs out there and the number of people who are available for jobs is closing and closing fast. So we're starting to get that. As I say, it's being stretched out more than normal. But I think that is unfolding. And then you get the effects on consumer spending. When income is weak, spending is weak. And let's say retail sales, adjusted for inflation, have been declining for the last few months. Everybody says strong consumer. Well, I don't know what they're looking at. They're not looking at inflation-adjusted spending because it has been declining. And then finally, if you look at just the typical recessionary pattern, it's capital spending. It's the spending on new plant and equipment that's the last to go. That's what happens when business is weak, and this is when you're into the recession and there's excess capacity. So who needs more? And you start to see the cutbacks in capital spending. And that's the whole pattern, and the whole thing lasts until, the Fed the Fed sees that they've really done the deflationary deed and they reverse gears. Now, one interesting aspect there, if you look at the last 4 business cycles, the Fed actually shifted gears from tightness to ease before the peak of business. Now, I need to explain that because I'm talking here about the Fed's policy rate, the federal funds rate, the overnight federal funds rate. That's their policy instrument. And I'm looking at that in relation to the recorded recessions. And recessions are determined not by any administration or Congress. And oh no, who would want to ever be in the job of saying the economy is moving into recession? That's left to this nonprofit organization called the National Bureau of Economic Research, NBER. And those are the guys who first studied business cycles in the 1930s. They studied them going back way over 100 years. And they're the guys who make the call. And the point is, though, that by the time they make the call, and they never want to change their mind. So they want to have all the evidence in and the revisions and be absolutely sure that the peak of business has been passed before they say. So it's normally months, quarters, even years later. And of course, that's about as handy as a pocket in your underwear for investing. So it means that you have to look to other things. And that's where we come back to things like the yield curve and leading indicators. But the point is that although the Fed in the last 4 cycles has shifted gears toward ease, even before the peak in business is recorded by NBER, I think this time they're going to be slow. They're going to be slow to reverse gears. And again, another reason why this whole recession, whatever you want to call it, is likely to stretch into next year. And that's because the Fed wants to make absolutely sure that they've killed inflation and they've killed it dead. So you've got the delays and layoffs, the delays in the Fed shift toward ease, which I think prolong the whole exercise.
Just to reset the room, everybody please make sure you follow Gary Shilling here on X. If any of you want to come up and ask questions, I see quite a few of you actually want to come up. Click that bottom left micro request button, check your DMs, prompt you when the time is right. And as always, this will be in podcast under Lead Lag Live on all of your favorite platforms, Spotify, Apple, and YouTube.
Historically, what happens is that the Fed shifts toward ease, as I say, in the last 4 cycles, even before the peak of business. But at that point, the weakness in corporate earnings and sales takes over to drive down stocks. So you have a period when interest rates are declining, but so are stocks. That's pretty normal. Now, let me just add one point here, not to be technical, but you say bonds. Technically, a treasury bond is an obligation that's issued with a maturity at issue date over 10 years, and they go out to 30 years. A treasury note is anything that is originally issued with a maturity 1 to 10 years later. And anything shorter than that is a treasury bill. And there's a lot of imprecision in this, and a lot of people talk about treasury bonds. They're really talking about 10-year treasury notes. And I hate to be a stickler on that, but there's a big difference between 10-year notes and 30-year bonds. And one of the important differences is that if you look at what happens when the Fed changes rates, either rises them or lowers them, it has effects further out on the yield curve. But the further out on the curve, the less the influence of the Fed. And that's how you get inverted yield curves. In other words, when the Fed raises the overnight rate, it has a much bigger effect on 2-year Treasury note yields than 10-year Treasury note yields. And by the time you get to 30-year bonds, as I mentioned earlier, historically, they are largely governed by inflation, not by what the Fed. There is some spillover, but it's really pretty minor. And that's how you get inverted yield curves, because the Fed raises rates and they affect the shorter end, but not the long end. So the Fed pushes the short end rates up, and the longer term rates don't rise as fast, and you get the inverted yield curve. I think the great hope here has been that, and this is the soft landing crowd, that the Fed will shift toward ease. And as you say, it's a Goldilocks world and everything is just wonderful and it takes away all the problems. Why is the Fed going to shift? The Fed's going to shift toward ease when the economy's falling apart. These guys are mere mortals and they're looking at the same data we are. And, they obviously are using a lot of judgment. You look within the Fed's policy committee, the FOMC, and you see wide differences of opinion just within. And those guys are, they're getting together every 6 weeks and supposedly all on the same page and so on. And yet you hear their pronouncements, and they can be wildly different in terms of what they think is happening out there. So, they're equally as baffled or enlightened as the rest of us in a sense. So I think that what would it take? Obviously, if you had a financial crisis, if you had a Lehman kind of collapse, well, I don't see anything like that. We don't have any of the excesses like the subprime mortgage bonanza that just are aching to be corrected and collapse, which was Bear Stearns and then Lehman and the whole dismemberment of the subprime market. I don't see anything like that. So it's probably going to be a combination of, weak consumer spending, housing, and further trouble. If there's one area that I would point out, and I'm doing this in our monthly newsletter, the one area that I think is probably the most vulnerable, and the one, if there is a major problem out there that would get the Fed's attention and everybody else's, it's commercial real estate. And, this is the idea that there has been a lot of financing of office buildings, but even hotels and other commercial real estate that is coming due in terms of financing. And of course, the financing was at much lower rates earlier. So with the higher rates and the declining occupancy, you end up with a lot of excess space on the market that depresses prices, and you have bankruptcies, et cetera, et cetera. Now, as I say, that may be a severe problem. There's always, of course, the outside kickers. Does Ukraine blow up? Does China, which is obviously a weakening economy, but is there a major glitch in China, both militarily and economically? I mean, you can always look for those outside crises that could cause the Fed. But there are other things. I mean, we've had a collapse of the crypto area. It's spectacular. It's interesting. It makes great reading, FTX. Yeah, I just love to read those articles about all the skullduggery that went on there. But in the greater scheme of things, the people involved got their heads handed to them, but it is not big enough to really sink the economy. It's nothing like the subprime bonanza that attracted so many people. People who were basically told that they could buy a house and they would never have to put a dime into the deal. Why? Because they would get a mortgage loan, and by the time the first payment came due, the house would appreciate and they could refinance it and actually even take money out of the deal. That's what a lot of people thought. And that was a very widespread. And of course, when it collapsed, and we were fortunate enough to be very, very profitable out of that. And when what's called credit default swaps, that's another whole subject, but I don't see anything like that. And, I've made a career looking for hidden flaws. I mean, I'm not the Wall Street Pollyanna who thinks everything is just going to be dandy. I think you add value, as I mentioned earlier, by seeing what's new or strange and exotic. And maybe I'll end up eating my words here, but I don't see anything right now that's in that category.
Okay, so let's talk about long duration treasuries here. It sounds to me like you're bullish, although timing obviously is always tricky and yields can always go higher. Obviously, it's nowhere near what yields were back in the 80s.
Yeah.
But do you find this to be one of those almost generational buys when it comes to long duration treasuries or more of a trade?
Well, what I call the bond rally of a lifetime back then is obviously largely completed. I mean, the yield on a 30-year bond was 14.3%. Now you got down below 3%. I mean, and I don't think it's going to go below zero. So simple arithmetic, you've had the vast majority of the play in bonds. That doesn't mean there isn't more. I think the investment scene shifts to real rates as opposed to nominal rates. And we have seen, as I'm sure you're aware, just recently, positive real rates. Now, they weren't positive for, a couple of years. You look at Fed funds, it only went positive. In other words, Fed funds rate above the inflation rate, that only occurred about 4 or 5 months ago. So you've only had those positive real rates, but I think that's I think that's where the action is going to be in bonds, and those real rates could be attractive. Again, it isn't a huge capital appreciation play. That's what the bond rate of a lifetime was all about. That's largely completed. But I think on a inflation adjusted yield basis, the uncertainty in the world, the safe haven aspect of treasuries and stocks being way overpriced, and we haven't really talked about that. But if you look at the cyclical adjusted price earnings ratio put together by my friend Bob Schiller at Yale, got a Nobel Prize for that and other work. But anyway, if you look at that cyclical adjusted price earnings ratio, which looks at the S&P index in relation to inflation adjusted earnings over the last 10 years to iron out cyclical fluctuations. Right now, it would take a 44% decline in the S&P to bring that ratio back to its long-term average of 17.1%. And that average goes back to 1880. Now, of course, you can always say this time is different. I think Sir John Templeton is credited with saying the most dangerous words in the English language are "this time is different." But if you put any faith in history, and I do, unless I see really substantial reasons to suggest you are getting dramatic shifts, and I don't in this case, then you say, hey, wait a minute, stocks are way overpriced. Well, obviously, and there are other measures of this. They talk about them in this September newsletter. But if you look at that and you say, wait a minute, an attractiveness of treasuries is the vulnerability of stocks. And I think that, I think you could not only have a further decline. We started early last year saying we thought we'd see a 40% decline in the S&P 500 peak to trough. It declined about 20% early last year, then rebounded. Now it would take about a 30% decline from here to get to that 30% peak to trough figure that we still are advocating. But, if you have that kind of weakness in stocks and then no great rebound, and I don't see any reason why, you don't have anything like a huge price earnings multiple expansion in prospects from my view. So if that's the case, it makes treasury bonds further attractive by comparison.
I will say real quick that I hope you're right, selfishly. I mean, this has been, professionally the most brutal 3-year period I've ever experienced in my own professional life. So I would love to see treasuries get back to that relative safe haven status, but you need to have some kind of, I think, quasi shock, at least to kind of bring back the correlation to the way it used to be. That's a whole different conversation.
Yeah. Well, I want to just say that the prospect of any repeat of what's happened in the last 30 some years is just not possible. You're going from 14.3% to 3% on the yields. And I always buy bonds. I don't care what the yield is as long as it's going down. I'm interested in appreciation in this bond rate of a lifetime. But I think that's changed now because you've largely depleted that decline in yields. And now it's the real yield, if you will, as I explained earlier, that I think is important from here. But, what should your strategy be? Again, I think right now that I would ease into treasuries. I wouldn't go whole hog right now, but I think that stocks are vulnerable, and the vulnerability of stocks, the likelihood that the economy is going to weaken, the safe haven aspects of treasury is going to be there, and that inflation is going to continue to ease. I think all these things favor treasuries. So I would think it makes sense to ease in this. But again, you can't expect a retreat of what's happened in the last 30 years. It's just not mathematically possible. I guess I'm just simple-minded. I like treasuries. And the reason is that understand high-grade corporates, it isn't like buying junk bonds where you got to worry about, are they going to be in business tomorrow? But, I just want to concentrate on the interest rate situation and not take the credit risk that you have with anything other than treasuries. So that's where I would stay. And, I don't have any objection to high-grade corporates, but as I say, to me, I'm in a KISS principle cap. Keep it simple, stupid, and that's me. You talked about duration. You can get any combination you want. I mean, if you want to, I tend to just buy 30-year bonds, but I determine the size of that position in our portfolios, in effect, as opposed to having some kind of a ladder or certain 10 years, certain 20-year etceteras. I just say, okay, if I really feel optimistic, I buy more 30 years. If I'm not as optimistic, I don't hold as many.
I'm curious, Gary, to hear your thoughts on the dollar, which we haven't talked about. I've joked before that last year was really abnormal and that it was a better inflation hedge than pretty much everything, including Bitcoin, gold. You can even argue tips, just, long dollar. That flight to safety dynamic obviously held true, right, when it came to the dollar last year. Do you think that the dollar is going to keep on appreciating or
that's
sideways?
We have portfolio recommendations every month in our monthly newsletter Insight, and that's one of the positions that we've had since May of last year is long the dollar. And it is a safe haven play more than anything else. And of course, when you've got the turmoil in Ukraine, belligerence of Russia and China and so on and so forth, and, weakness in Europe, etc., I think the dollar just makes a lot of sense. And I just continue to hold reasonably large dollar positions.
Do you think that at some point also becomes maybe a crisis point, right? I mean, the emerging markets, everyone's worried about the sovereign debt crisis outside the U.S.
Well, that's a very interesting point because if you go back, half a dozen years, there was real concern about rising federal deficits and borrowing, sinking the ship. And, who was it? A representative from Wisconsin. He was Speaker of the House. Gosh, can't remember anybody. But anyway, he was very vehement on the whole idea that if you didn't curb the deficits, that the world was going to come to an end. Well, it hasn't. And despite these soaring deficits, and I'm no fan of government deficits for no other reason that I think most government spending is inefficient. And I'd rather see it in the private sector where there is a discipline of profits and a bottom line. But in any event, the reality is that despite the huge issuance of treasuries, it hasn't really screwed up the interest rate market. And so what happens? Now, theory follows fact. Whenever you get a series of facts, there's a cosmic need to dream up a theory to explain it. And this one is called modern monetary theory. And it basically says that there's so much money out there that it doesn't matter what the treasury issues, it's going to be absorbed. And that's that's the explanation. Now, we've done some work on that over the years. And what we looked at, we said, okay, but let's look at this from a standpoint of what we call a debt bomb. Now, what I mean, the way I define a debt bomb, and we've written this up several times in our monthly newsletter, a debt bomb is a situation of where the interest on the debt becomes such a big component of the deficit that it adds to the debt and the whole thing takes off geometrically, if you follow what I'm saying. In other words, you're just getting this ever-growing interest component of the deficit. And of course, the deficits add to the debt and the whole thing grows geometrically. Well, that's never happened. It's never happened. But the closest you came was back in the 1990s. And we looked at that and we said, okay, in today's world, where would you need to be in terms of average interest on treasuries to get to that level? Now, that level was not a debt bomb, but it was the closest you've ever come to it. And what it says is that the average return on treasuries, and of course, most treasuries are very short term, so it holds down the yield, but it's about 4% now. It would have to go to about 8% to get back to where you were in the 1990s. And as I say, even that was not the debt bomb in the sense that it was growing geometrically. So, to say that this is going to sink the ship, it certainly, trees don't grow to the sky. Conditions can't last forever. I'm no fan of deficits, but I think there's a lot of other things that are much more important and worth worrying about than this, even though I'm no fan of government debt and deficits.
Gary, for those who want to track more of your work or get access to insights, where do you point them to?
Well, what you can do is you can go to our website, www.garyshilling.com. That will give you information. Or you can call our toll-free number if you're interested in a sample copy of our newsletter. And I'll give you the number. It's 888-346-7444. 888-346-7444. That's toll free. And if anyone's interested, we'll send you a copy of our, and it's just coming out, our September newsletter, and you can see for yourself how we approach the problem of the economy and financial markets and whether it's something you want to keep track of.
And no complimentary jars of honey, or it's a part of the subscription, given you work with honeys and bees.
Well, that's our Insight subscribers get a free jar of honey every year. That's a bonus because we produce quite a lot of it. And in a good year, we'll produce 4,000 or 5,000 1-pound jars of honey, and we basically give it away. I've never sold any. If I did, I'd have to start keeping the books, and I don't want to make myself cry because it's so labor intensive that my time would probably end up worthing $1 an hour with a minus sign in front of it.
Speaking about deflation, anyway, everybody please make sure you follow Gary Shilling here on Spaces, on Twitter, on X, and obviously subscribe to his research. This will be a podcast under Lead Lag Live on Apple, Spotify, YouTube. And thank you, Gary. I really do appreciate your knowledge and everything you've contributed over the last several decades.